Good evening. This is financial management. Yeah? So we are going to look at chapter 1, Introduction to Financial Management. Alright, so let's start. Yeah? So we are going to look at 5 key concepts in this chapter. The first concept is about financial management. Yeah? What is financial management and the role of the financial manager? Okay, as you can see here, okay, let me just get the pointer. Alright, I can't get the pointer here because it's being recorded. Yeah. Alright, so we look at the financial management, okay, and then we look at the role of financial manager. That's the first key concept. Then the second key concept will be the different forms of business organizations, different types of businesses. So that's the second key concept that we'll learn in this chapter. And the third is the goal of financial management. It's the goal of financial management. Then the fourth key concept in this chapter is what we call agency conflict. Okay, the conflict of interest that can arise between managers and owners in a business, particularly a company or a corporation. And the last part, okay, the last key concept will be to explain the different types of financial markets. So the last key concept in this chapter will be financial markets. Okay, how are they useful for organizations, or businesses in particular? All right. So let's move on. This is the chapter outline. So we look at financial management or corporate finance. We'll come to this term a bit later. It means the same thing generally. Alright, and then we look at the financial manager. That's the first key concept. The second key concept is the forms of business organizations or different types of businesses. Okay, there are 3 types. We look at those, and then the third key concept will be the goal of financial management. What is the goal of financial management? And the fourth key concept is the agency problem. Or we call it the agency conflict. Okay, and the control of companies, which is one form of business organization. And the last key concept here will be financial markets, and how companies, or businesses in general relate to the financial markets. Okay, right. So let's go to the first key concept, which is corporate finance or financial management. So financial management is a general term. Corporate finance is a more specific term. So if you like, corporate finance is to do with financial management of companies, or corporations. But financial management is a broader term that refers to financial management or managing the finances of any businesses. Okay, or any business or any organization, not only for-profit organizations, but also non-profit organizations like non-governmental organizations or some agencies, non-profit agencies and so on. So the general term would be financial management. Okay, but many of the concepts that we will learn here applies directly to corporate finance as well. Alright, so what are we going to look at in this financial management? There are 3 key decisions or questions that need to be answered. Okay, the first one is to do with long-term investments. So what are the long-term investments that a company should undertake, or take on? That's the first key decision that the financial manager needs to make. Then the second key decision is, okay, what are the long-term financing methods that will be used by the company to get the funds for the investment. Right? So this is the second decision. The first decision is long-term investment. The second decision will be long-term financing. And the third decision is how will we manage the everyday financial activities of the firm. Okay, so this is more short term. If you look at the key terms here, the first two has to do with long term. Long term investment, and this is long term financing. And then here you have everyday financial activities. And this is to do with short term. Everyday means short term. Usually long term and short term, the demarcation is rather arbitrary, but by convention, we say anything longer than 1 year is long term, and anything less than 1 year or equal to 1 year, we call this short term. That is the conventional demarcation between long term and short term. Alright, so there are three major decisions that a financial manager needs to make. These are the three major decisions or questions for which they need to find the answers. Alright, and the first one is the core. The first one, which is long-term investment, is the core decision that the company needs to make or the business needs to make. Because the existence of the organization is to make money. We'll look at the goal of financial management a bit later. But in order to achieve that goal, the long-term investment will play a major role. Right? Therefore, long-term investments will be the major or the key decision that a company undertakes. Now, the second decision is long-term financing. This long-term financing will be driven by the long-term investment decisions. The more investments you make, then you need more funding for those investments. So where do you get this funding? Is it from debt, borrowing, or would you get it from equity investors? So these are the decisions that you will make in the second question, which is where will we get the long-term funding or financing for the investments. And the last one has to do with short-term financing or financial activities. When we say financing, it is borrowing or obtaining funds. But financial is a greater term or a broader term. Financial includes financing as well as investment. So here you will have both short-term investments. The third decision will include short-term investment and short-term financing activities. And this also includes the payment, collection of payment from customers, making payments to suppliers. All that will come under this third decision. Alright. So these are the major decisions. All the decisions that a financial manager makes, you can categorize them into these three groups, or you can put them into these three categories. Let's move on. Alright, so these three categories, we have specific terms to refer to these three decisions. The first one is capital budgeting, because capital budgeting is a term used to refer to long-term investment decisions. So what long-term investments or projects should the business take on? So this decision is addressed by the capital budgeting decision. We call this capital budgeting. Right. The second decision is to do with long-term financing, and we call this capital structure decisions. So some of the decisions that the company needs to make or the business needs to make will be how should we pay for our assets. So meaning, where do we get the funds to purchase our assets? Alright. And then, should we use debt, borrowing, or should we use equity, investors' funds? Alright, so this comes under capital structure decision. Alright, and the third and final decision will be working capital management. We call this working capital, or sometimes we call this liquidity management. Alright, so working capital management has to do with short term, and here we look at day-to-day finances of the firm. Right, so these are the three key decisions made by the financial manager. Alright, so these financial decisions can be illustrated using the balance sheet. This is what a balance sheet looks like. This is the format of the balance sheet in simple terms. okay, or in a simple format. Yeah, the balance sheet. We'll look at the balance sheet in greater detail in the next chapter. Okay, but here a balance sheet, very briefly, yeah, will tell you the financial position of a business. Okay, so it tells you the current assets, the assets. Yeah? Generally, on the left hand side you have the assets, and on the right hand side you have the funds, yeah, used to purchase the assets. So you have liabilities, okay, and also long-term funds. Right, these long-term funds can come from debt, borrowing, or can come from investors' funds, yeah, meaning shareholders' funds, or the owner's funds. Yeah, we call this owner's equity. Alright, yeah, so here you can see that the assets, yeah, the assets portion will make up the investment decision. Yeah? But in particular, the decisions that relate to fixed assets are called capital budgeting. Yeah? So you can see here, capital budgeting decisions relate to the fixed assets portion because these are long-term investments. Okay, and then when you look at capital structure, which is here, okay, this is long-term funds. Yeah? Whether we get long-term debt, okay, or you have equity funds to support the purchase of fixed assets, yeah, or long-term investments, and this comes under capital structure decisions. Okay, right. That is the second category of financial decisions, and the third will be working capital. Yeah? Working capital straddles both assets and liabilities, yeah, but only short term. We call this current assets and current liabilities. Yeah? So the decisions that relate to, yeah, the purchase of current assets, or the tying up of funds in current assets, or purchase of current assets, and the obtaining of funds through current liabilities will come under the purview, yeah, of working capital decisions, yeah, or under working capital. So in the balance sheet we can visualize, yeah, the three decisions that the financial manager needs to make. One is working capital decisions, which is short term, okay, or day-to-day activities of the firm will be reflected in this. Then you have the capital budgeting decisions, long-term investment decisions here, the fixed assets, and here you have the capital structure decisions, yeah, to do with long-term funds. Yeah? How you obtain the long-term funds in order to purchase this long-term investments, yeah, or to make this long-term investments. Okay, so these are the financial decisions made by the financial manager. Yeah, right. Now we look at the role of the financial manager. Yeah, as we have seen, the financial manager will try to answer, yeah, some or all of these questions that we have seen previously. Okay, and in a firm, normally the top financial manager will be called the chief financial officer, okay, CFO, or sometimes called the vice president of finance. Yeah? Okay, in other organizations they may use a slightly different term, yeah, but these two terms are the most popular: CFO or vice president of finance. Yeah? So these persons are the ones responsible for the financial decisions made by an organization. Yeah? Alright, there are other managers who report to this chief financial officer or the vice president of finance. Okay, we have two major roles. Yeah? One is called the treasurer, the other is called the controller. Yeah? They both report to the chief financial officer. Okay, and the treasurer will deal with cash management, credit management, capital expenditure, and financial planning. Yeah? So the treasurer will deal with more of the financial manager's decisions. Yeah? Now if you look at the controller, okay, the controller will oversee taxes, yeah, cost accounting, financial accounting, and data processing. Yeah? So this controller's role is more of an accounting, yeah, based role, yeah, not so much finance. Yeah? There will be some payment of taxes, yeah, the computation of taxes, the reporting, all that will come under the controller. Yeah? but the trend